Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Impact of COVID-19 Pandemic on the Global Energy Markets. We are grateful to Ken Koyama and Yukari Yamashita from the Institute of Energy Economics, Japan, for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have a question for the panelist, please click the Q&A button at the bottom of your Zoom window and type your question. We kindly ask that you do not send your questions by email. We've allocated plenty of time at the end of this webinar to address your questions. And now I would like to introduce you to our moderator, Dr. Yukari Yamashita, Board Member Director of the Institute of Energy Economics, Japan, as well as the current IAEE President, and our keynote speaker, Ken Koyama, who is Managing Director, Chief Economist, Institute of Energy Economics, Japan. Yukari, over to you.
Thank you, Dave. Hello, listeners. Thank you for joining us today. I hope everybody is staying safe. My name is Yukari Yamashita, and I am your IAEE President for 2020 and today's moderator. It is unfortunate that the outbreak of COVID-19 prevents us from seeing each other face-to-face at the IAEE conferences, but instead, I sincerely hope that you will enjoy exciting webinar series Dave and his staff have been compiling, and then we are joining. Today, I have a pleasure of introducing my colleague, Ken Koyama. Dr. Ken Koyama is a chief economist and managing director at the Institute of Energy Economics, Japan. He is a visiting professor at the Graduate School of Public Policy, University of Tokyo, and an adjunct professor at the Institute of Innovative Research, Tokyo Institute of Technology. From the Waseda University, Tokyo, Japan, he was awarded a BA in Economics in 1982 and a MA in Economics in 1986. He completed his PhD at the University of Dundee, Scotland in 2001. His specialized fields of research include global energy markets and policy issues related to energy security and geopolitics, with emphasis on the Asia-Pacific region. On many occasions, he served as a member of energy policy advisory councils and committees of the Japanese government. He has many other titles, but I would like to introduce Ken Koyama for you for today's presentation on the how the coronavirus has changed the global energy scene. So floor is yours to you, Ken.
Thank you, Yukari, and thank you, Dave, for your kind introduction. Good day to everybody. It's a great pleasure to be a speaker at today's webinar. I hope that I can have a very fruitful time for everybody to discuss today's topic of the impact of COVID-19 on the global energy market. My views, which is a very important, most important subject matter for all the energy stakeholders in the world. So let me start by saying that I hope that the slide is not moving. Okay. Let me start by saying that the year 2020, we already started also called oversupplied market, even before the pandemic. Everybody knows that the year 2020 started with pressure for downward pressure for prices, not only for oil, gas, but also LNG. But unfortunately, COVID-19 outbreak in China developed into pandemic. And under the circumstance, we all know that the global economy is now in a kind of worst situation since the Great Depression. And furthermore, it is very important to note that the city lockdown has a serious implication for the global energy market, in particular, disrupting the oil demand. So we are now seeing a very, very strong, unprecedented demand shock. But not only demand shock, we are witnessing the very important development with regard to the supply side. The joint production reduction effort by OPEC Plus collapsed in early March, and followed by the extremely low oil price, that the joint oil production effort was restored. But we believe that the current enormous supply glut likely to continue and continue to put the pressure or a downward pressure for oil market, gas market, LNG market. This simple chart illustrates how volatile the oil price is, and in particular, after the March collapse, oil price actually plummeted to the extremely low price levels. We all know that April 21st, the WTI front month recorded the minus price, where the seller could not find any buyers in the marketplace, so that the price should go down below zero. It is extremely extreme event. But the fact is that we are seeing a strong downward pressure for oil price because of the enormous supply surplus created by the pandemic, created by the demand destruction. The background factor is, of course, the very serious world economic situation. This table illustrates the latest IMF World Economic Outlook, published April 14th. In the right-hand side of the table, where the character is shown in red, the latest IMF figures published in April, that we are seeing that the global economy is very likely to contract by 3%. As you know, that IMF regularly published its World Economic Outlook. The previous one was January. At that time, the global economy was projected to grow 3.3%. Just 3 months' time, the situation, that the world landscape changed substantially. And in particular, we can all notice that the economy in the United States and Europe, advanced economy, hit hardest because of the pandemic and because of the enormous suffering of the people and economy. And at this moment, I just want to attract your attention that the issue of the importance of the 3 elements for the economy: the people, goods, and money. Put it in very simply, the well-functioning of people, goods, money, the 3 elements, is really important, essential for the normal economic activities. And in this regard, I'd like to point out that COVID-19 pandemic creates a very serious, very serious problem for people and goods. In other words, that the pandemic is actually damaged the so-called real economy. And after the damage to the real economy started, then the money problem hits the wall, leading to a kind of vicious cycle. And this vicious cycle is still working on. In contrast to this COVID-19 pandemic situation, we can recall that the Lehman shock or 2008-2009 financial crisis, the bottom line was the money problem created by the bankruptcy of Lehman Brothers. And this could damage the financial market first. in the United States and in the world, and then the real economy damaged worldwide. And before the pandemic, we all remember that the most serious threat to the world economy was US-China trade war. And by definition, trade war is the war for the tariff, and good problem caused the reduction in the world trade and world economy, and then money problem followed. So this is a characteristic of the current COVID-19 pandemic on economy. And the important issue here is implication for energy. The problem for people and goods creates the enormous problem for energy demand because of the problem caused for the real economic sectors. With this in mind, IEEJ made a series of special studies on these issues, namely the impact on the demand side created by the slower economic growth and the impact of city lockdown. Based on IMF projection, latest projection, we prepared two scenarios. One is a reference scenario, RS, and the other is a longer pandemic scenario, RPS. While RS assumes that 3% minus growth for the world, LPS assumes that 6% growth for this year. Under this major assumption, of course, we made various other assumptions, the detailed assumption. The oil demand in the world is projected to decline very substantially for this year. In the RS shown in blue bar, the global oil demand will decline by 9.3 million barrels per day, 9%, as compared to the previous year, 2019. As you can see from the right-hand side picture, the oil demand by quarter, it's quite obvious. The most serious damage to the oil demand in the world is happening in this quarter, second quarter. And this is mainly because of the impact of city lockdown, which I will come back on later. Of course, the economy is very serious, but the fact is that oil demand, which is a major transportation fuel in the world, was seriously hit during this period. According to our analysis, in the RS, the global oil demand in the second quarter declined by about 16 million barrels per day as compared to the previous year's period. And I would like to also mention that depending on the assumption on the seriousness of the city lockdown, the demand for oil in the world, in particular in major consuming areas like United States and Europe, will be seriously affected. In other words, if we assume the longer period of city lockdown, if we assume the more serious stringent measure for the lockdown, the demand for oil will be hit harder and harder. And on the contrary, if we assume the city lockdown will be eased earlier than our anticipation, the demand recovery may be faster. So many things depend on the extent or degree of city lockdown. This slide illustrates the oil demand reduction versus 2020 level by region and by product. As you can easily guess by region, it is United States and it is Europe where the pandemic hit hardest, that the demand for oil declined most substantially. Of course, oil demand in China, oil demand in other non-OECD Asia will be reduced very substantially, but because of the impact of the city lockdown and because of the impact of the pandemic itself, the demand for this advanced area, economic area, will be reduced most significantly. And of course, by product, you can see the significant amount of reduction in gasoline, jet fuel, and gas oil, which is a major transportation fuel, is the victim for this pandemic in terms of the demand destruction. What about the gas? Of course, the demand reduction, the level of reduction is not as high as oil, but still we can see the serious impact on the gas demand. You can see for the right-hand side picture, the natural gas demand in the world continued to a steady growth up to 2090. But in RS, the demand will be reduced to the level of the 2 years ago, 2017. And if we assume that RPS, the demand reduction level is much, much higher. And we also made a special analysis on LNG, liquefied natural gas demand in the world. And even in contrast to the natural gas itself, the global LNG demand recorded a very, very strong, sound growth in the year 2017, 2018, and 2019, supported by the strong growth in China, non-OECD Asia, in some part in Europe. But in RS, the global LNG demand will decline substantially to the level of 325 million tons in the RS. We can recall, even at the time of the Lehman crisis, financial crisis in 2009, the global LNG demand continued to grow. But now we are going to see the possible decline of LNG demand for this year because of the impact of the pandemic. And this picture illustrates the implication, the demand destruction versus 2020 level for gas and LNG. And this is also quite obvious. The place of the major consuming area will be hit hardest. For natural gas, the major consuming area in the world is North America, Europe, and former Soviet Union. And because of the pandemic and the slower growth, everything lead to the substantial reduction of natural gas demand in these major consuming area for gas. And this is similar to the case of LNG, where you can find the picture for the right-hand side, OECD Europe, OECD Asia, Oceania, which include Japan and Korea, and China, and other non-OECD Asia, LNG demand declined most substantially under this extremely difficult economic and social environment. Europe, OECD Asia, and the non-OECD Asia account for the more than 90% of total reduction in the global LNG demand reduction for this year. And this picture illustrates our analysis on the city lockdown. This is the picture for the reduction per day for all energy, final energy consumption by region. And you can see how big for the reduction of North America and advanced European economy is. Of course, the final energy demand reduction in Asia is substantial, but because of the strength of city lockdown and because of the larger per capita energy consumption, the impact of North America and Europe is much, much larger than the case in Asia. And this picture also illustrates the impact of the city lockdown by final energy reduction by energy and by sector. And at the lower part of the slide, we also calculated the impact on primary energy reduction by source of energy. But it is very simply, the impact for the transportation sector is too big, so big, the global oil demand reduction is really enormous. According to our analysis, according to our assumptions, the global oil demand will be reduced by 18 million barrels per day, which is a 20% reduction as compared to normal situation. Of course, the gas demand will decline by 11%, coal demand 8%, which is significant. But it is clearly indicated the city lockdown is a major source of reduction in transportation, which means that oil demand. So again, what I'd like to mention here is depending on the future course of the city lockdown, that the global oil demand trajectory will change dramatically. If we continue to see a very strong lockdown, the oil demand may likely to remain low. But if we really see some recovery from the city lockdown, it's possible that oil demand recovery pace is much higher. And under the circumstance, we saw that a very strong supply shock. Of course, in normal circumstance, when oil demand is collapsing, the supply side should play a role to stabilize the market. But from early April, what happened was the contrary. Saudi Arabia and Russia decided to go on the price war, which lead to the strict low oil price. And finally, earlier this month, Mr. Trump started to intervene as a mediator in the OPEC Plus negotiation. And we saw that from April 20th and 12th, OPEC Plus decided to announce that the 9.7 million barrels per day joint production cut from May to June, followed by the reduced joint production cut. But 9.7 million barrels per day reduction is historic high agreement to reduce supply. But we all know market judgment is this volume is not enough. But I would like to talk about something about the situation respectively in Russia, Saudi Arabia, and the United States. Why Russia first rejected the joint production effort in early March? In my view, this is a strategic decision made by Mr. Putin. In his view, that the OPEC Plus cut benefit only the US share, which is a high-cost producer, and just benefiting to US or US shale is not acceptable from the viewpoint of national interest. And at the time of the early March, Russia seems to argue that Russia can survive the global oil price environment longer than Saudi Arabia because of the lower break-even fiscal price, which they said that about $40 per barrel, while Saudi fiscal break-even price is calculated at around $70, $80, which is higher, much higher than Russia. But I think that impact of the low price was much bigger or beyond anticipation. In particular, together with demand destruction and the demand destruction in Europe. As we all know that the European market is a major outlet of Russian energy supply, oil and gas. So I do believe the pain felt by Russia was too acute. What about Saudi? The Saudi economy and society now requires higher prices because of the various reasons which you know very well. And the supporting oil price is a really important issue for the stakeholder, the policy planning in Saudi Arabia. But at the same time, we all know that Saudi always put emphasis on the joint production cut. In other words, the Saudi do not want to be a single swing producer anymore. But once this joint production cut effort collapsed by Russian rejection, the Saudi decided to reverse its policy to head for the market share and price war in the idea of lose the battle to win the war strategy. The pain of extremely low prices can become a driver for the restoration of a joint cut. As we all know, in the middle of 1980s, in the end of 1990s, at the second half of 2014, that past 3 times, the pain of low price resulted in the restoration of joint production cut of major producer in the world. But again, this lose the battle to win war strategy, the pain was again beyond anticipation even for Saudi Arabia. And also, when there was a call from Mr. Trump, it is very important to hear seriously about his call. So, and the United States situation is also very unique and very, very significant. We all know, in average, US shale oil is still a high-cost production, in particular as compared to the Saudi Arabia and even some of the very efficient field in Russia. But below $20 caused serious damage to shale revolution because of the high-cost nature, and this is a destructive, very, very destructive impact on the US shale industry, which supported the US economic growth in the past 10 years. And also, in the current energy and stock market interaction, low oil price tend to cause a lower New York stock price, which is also very painful economically and both politically for Mr. Trump in particular. That's why he decided to mediate Russian-Saudi price war. So in a sense, he was very successful to lead to the agreement of historic OPEC plus joint production reduction of about 10 million barrels per day. But many producers hope that the US will join the production cut. But ironically, US production continued to be in the hand of the market mechanism. Of course, in the hand of the market mechanism, when the price is very low, under the current situation, US oil production is likely to be reduced. So we can count on this, the impact of the market mechanism in case of the US oil production, but of course, US cannot join as Russia or Saudi is doing. Now the problem is stock building. Everybody knows. If we assume that the 10 million barrels per day surplus, in 10 days' time, the oil stock will increase by 100 million barrels. In 1 month, 300 million barrels. That's why IEA and other experts is now suggesting sometime in May or June, the global oil inventory capacity, in particular for the land-based tank capacity, will be filled up, which means a real disaster for the oil market. Oil became a kind of a valueless product, which is a kind of a reflection of what happened in WTI price in April 21st. So we need a very serious effort, joint effort by producer and consumer to avoid this real disaster for the world oil industry. Again, much depends on the future course of the demand and the effort of producers to reduce supply and impact of low oil price for the production in case of United States in particular, but also in other part of the world. But it's very simply, we continue to see a very strong downward pressure for oil price in the world. We are seeing the start of the joint production cut, but if the actual demand for oil at this moment contracted by more than 20 million barrels per day, I do believe that it is quite possible that the oil price may become lower. In particular, that if we believe that the destabilization of the world is with uncertainty continued, oil price may go down to below $10. I'd like to draw attention to the next topic of LNG. As I mentioned, even before the pandemic started, IEEJ argued that this year the global LNG market may be an oversupplied market. Shown in the blue and the red bar, the blue LNG supply capacity exceed the demand projection before the pandemic of 369 million tons. But based on our latest analysis of the global LNG demand for RS and LPS, which is much lower than the projection made by last December, we are going to see the big gap between demand level and supply capacity. That's why we are going to see that the strong downward pressure for the LNG spot price, which reflects the demand-supply situation shown in the orange line. Asian LNG spot prices are now hovering at around the sum in the first half of the $2 per million BTUs, while the Japan LNG average landed price, shown in purple line, is still much higher level. This is simply because of the function of time lag. The Japan's LNG average price is majorly indexed to crude oil price with a time lag around 3 to 5 months time. As we know, that oil price collapse started in early March. Sometime this summer, we are going to see the strong reduction in average crude oil indexed LNG price in Japan and in Asia. In any case, we will see that the lower price level for LNG, both in long-term contract LNG price as well as spot prices, which will then create another issue of the competitiveness of US LNG, which is priced off that Henry Hub price fixed cost, which means that liquefaction cost and transportation cost. So depending on the level of the decline of the price of JCC LNG and spot LNG and the price of Henry Hub and US LNG, the market situation became more and more complicated, both for producer of LNG and consumer of LNG. But in any case, we are going to see a very strong oversupplied LNG market for this year. This is partly because of the lack of OPEC Plus in LNG market. We discussed OPEC Plus decided to reduce oil supply by 10 million barrels per day, which is a 10% reduction of total supply in the world. Unfortunately, in LNG market, there is no OPEC Plus. In this way, the LNG supply is not flexible. In my view, that the only possible flexible supply source may come from the US LNG. But in any case, we will see the very strong pressure for downwards pressure for spot LNG price from now on, and followed by the lower oil priced term LNG price. And also, I can point out that many people projected that the oversupplied market remain longer, but probably because of the pandemic, I think that the period of oversupply might extend to 2021, 2022, I don't know, but anyway, that the situation is very serious for the global LNG market. And let me point out that the last point, last but not least, which is a long-term and the structural implication of COVID-19 pandemic for the world energy market. So far, I point out that the short term, very eminent, very serious implication of pandemic, which is creating the oversupply, enormous oversupply, strong down pressure for prices. But I think that the long-term structural implication is also very, very important for the stakeholder in this area. Firstly, we may see the transportation demand for people and goods may structurally restrained. We are now seeing, just as this webinar, we try to avoid to move by ourselves. We are going to use telework and everything to reduce the transportation demand for the purpose of safety and for the purpose of security of ourselves and society. And this reduced transportation demand is now substituted by the function of digitalization or IT. What does this mean? Even after assuming everything is going to normalize, that situation, world situation, come back as normal, I don't know. If this substitution effect remain in some part, oil demand structurally restrained, and this will lead to the acceleration of electrification in our society. I don't have answer to this question, but it is possible that the current, what's happening now in our society, in our life, and in our economy will have a longer term implication of the shift in energy use, acceleration of electrification. And also the second point is the possible shift on the priority for the energy policy agenda. Of course, I have no doubt that decarbonization, that addressing the climate change, continue to be the very, very important challenge for human beings. But what happens now is we are in a war for survival. We are seriously affected by this pandemic. So clearly, every country, every society is putting real priority on safety, security. So does this have some implication in the priority for the so-called 3Es? This is a kind of open question, but we all remember in the history of the world oil or world energy transition, some of the very serious events creates a big shift in perception. And this shift in perception matters a lot in terms of the energy policy making to promote something different before and after. And this is also very important in considering the fact that the current pandemic shed light on the importance of so-called big government to address the crisis that everybody, every society understands the importance of the role of big government. How this big government plays a role to promote the safety and security and the rise of the so-called me first trend and policy. Me first means the priority to protect the citizen of the nation, to protect our own country, our own nation, our own economy may have the implication for the global geopolitics, which tend to create another issue of global geopolitics of energy. Under the circumstance, every country seems to prioritize the so-called self-sufficiency for the safety of the people, for the safety of the country, and for the safety of the economy. What all this means has a longer-term implication with regard to the government energy policy and long-term energy strategy. So I'll stop here and thank you very much for your attention. I'll be very, very happy to have a discussion with the listener of this webinar. Thank you very much indeed.
Thank you, Ken. I have a few questions from the listener, but I also have to ask you a question as a privilege of the moderator.
Sure.
We hear recently the news about the lifting of the lockdown in a few cities, or partially lifting the lockdown of the economic activities, such as in construction or transport. How do you envision which one of your cases matches that? Is it still the reference scenario event that if the partial lifting of the lockdown to be happening in several states in the U.S., etc.?
Thank you, Yukari, for your question. And my short answer is we are seeing some possible easing of the lockdown, because the major assumption for our analysis is lockdown period is 60 days. So we did not assume that whole quarter period or 3 months period lockdown. So in particular, mainly in some period of March, April is the assumed period of lockdown. Of course, that my colleague made a more detailed analysis by country for the lockdown, but in general, 60 days, which means after 6 days is passed, that this lockdown will be eased or lifted. That's why, as I shown in my slide, in the third quarter, fourth quarter, oil demand goes up. But again, I just think there is a big uncertainty over the strength of the lockdown itself.
Mm-hmm.
How the government tried to restrict the movement, I don't know. And how people react is, again, the open question.
Mm-hmm.
As we all know, as a Japanese government made a declaration of emergency in April 7th, but our emergency declaration has no binding control.
Mm-hmm.
Much depends on the people's reaction.
Mm-hmm.
The government just request us to stay home,
Right.
not to move, not to go out. But depending on the people reaction, we will see the impact on the demand for transportation. So if assuming that in some, say, advanced economy in European country or some of the US states, when the government says, okay, now we are going to ease, and the people react to go back to the more normalized civil life or economic life, I think that the demand rebound is very substantial. But I don't know if the people stay at home, even after the easing of the restriction, I think that the demand level continue to be restrained.
But
So
on the other hand, you feel that the once the lockdown is lifted, the people's reaction, like the demand to pick up, will be relatively fast. That is your observation. May I go into the next question? I have a question from Jonathan Starn. He has actually two questions, I think. The great presentation. Can you say a little more about the impact outside transportation? Your projections indicate a smaller decline for global coal demand compared to gas demand. Should we take that to mean that gas will lose out to coal in power generation? Or does your 11% fall in global gas demand reflect a stronger decline in the industrial and commercial sectors, particularly in North America, Europe, and FSU?
Thank you very much indeed.
So I would appreciate, in addition to answering to his question, also mention in general, other part of the sectors or other energy resources. How will it be affected? If you have anything to add.
Thank you very much, Johnson, for your great question. Yes, when we made the analysis, we found that when the economic situation deteriorate, I think that the price competitiveness matters a lot. So put it very simply, when the situation in particular for many countries, including Asia, that preference for the more economically competitive energy source is eminent. In other words, the natural gas may lose out as compared to coal. Both coal and natural gas will be reduced, that the level of reduction will be affected by the observed price competitiveness. So that's why the reduction level of coal is lower than the reduction level of natural gas. I think that it is quite possible to happen in the world when, in particular, economic situation worsen in the historic level. In other words, that if economic situation is more normalized, people may pay attention to the environmental impact, but under the current extremely difficult situation, I think that the preference for price competitiveness is much stronger. That's why there is some difference in the level of reduction as compared to coal and gas. I hope that this answers the major question to be raised by Jonathan. But I may miss the second part of his question. Can you come back to the second part?
The second part is actually about the North American or the Europe or FSU. The 11% fall in global gas demand, does it reflect a strong decline in the industrial and commercial sectors, particularly in these regions, rather than directly related to the transport demand or fire the power plants?
Yeah, I think that's the answer. Of course, in case of oil, the transportation sector is a key. But for gas and other energy sources like coal, I think that the industrial and the power sector's consumption is a major part. So in the case of gas demand reduction in America, in Europe, and FSU, it doesn't matter about the transportation. It's a matter of industrial activity. It's a matter of power generation, and it's a matter of non-transportation sector. That's why the reduction in these major consuming area is seriously affected.
Okay, thank you. May I move on to the second question from the audience? Sure. This is anonymous viewer, and then I think this is related to Japan. Good presentation, thanks. What is the implication to coal and nuclear energy going forward beyond COVID-19? So it's a little bit different. It includes the nuclear. These are actually considered as a major the base load source of power generation for Japan. How do you envision the influence after the COVID?
I'm going to talk about case of Japan. My very personal view is that post-pandemic period, we need to discuss the balance of 3E concept in a new environment. Japan or Japanese government continue to highlight the balanced approach toward energy security and environmental protection and economic efficiency. And based on this idea that the government established that our 2030 energy mix target, which represent 20 to 22% for nuclear, 22 to 24% renewable, 26% coal, 27% LNG, which I remember correctly. And the government set this target and trying to meet this, because this numbers is the only possible solution in our view to meet the 3E target simultaneously. But the reality is that the nuclear target is very, very challenging.
Mhm.
So what is going to happen in nuclear is a really important key element to the question of Japan's energy policy. But the post-pandemic situation, I think that diversification and energy self-sufficiency may be highlighted or that shed a new light on this discussion.
Mhm.
I do believe that for the next round of the Japan's basic energy policy debate, which
Mhm.
may happen this year, I don't know, because of the serious
Situation.
impact on these issues. But if we see the next round of that discussion among government, among the advisory committee in Japan, I think that this new possible right shed for nuclear power may be the very important issues. Of course, that the nuclear situation continues to face a serious difficulties and complications in our society because of the enormous impact of Fukushima for the people's perception of nuclear. But I think that for the government point of view, that we need to enhance that approach to address the three in the more balanced manner. Before the pandemic start, I think that everybody is just talking about the decarbonization, which is important. But I think that the energy security and protection of economy may become the new or very newly addressed important agenda. And I think that this may impact on the discussion on nuclear power. I don't know at this moment, but I'm just talking my sense at this moment. But
Right.
I think it's quite possible to have a new dynamics for the discussion on nuclear power in particular.
Excuse me for having asked you a tough question, but I was also curious what will be inside your head. Thank you very much for sharing your views. This is actually the same question I had as the viewer. The viewer's question, the third one, actually it is again from the Jonathan Start. Even though the fall in the oil price will be reflected in LNG prices later this year, do you think that the current LNG situation of oversupply for the next several years may move Asia away from crude oil linked and towards spot prices? It is an LNG pricing question.
Okay. I think that this is a trend. As I continue to discuss this with Jonathan, but I think that there is a growing, continued trend to be away from that the JCC crude oil pricing. Of course, it depends on the so-called current situation. If the price of oil remain high while the spot price is extremely low, it's quite easy to say, oh, we need to go away from JCC. But if the market situation changes, the pace and the speed of this trend will be seriously affected. But everybody, in my view, understands the fundamental question of JCC linkage. I think that the JCC pricing played a very, very important role in our history of LNG market in the past 50 years. The last year was a very historic anniversary of 50 years for our LNG importation for Japanese market. Actually, this pricing is a key cornerstone of the stability of the industry. But I think that the situation is really changing. But I do believe even before, even the impact of the COVID, without or with the COVID, I think that this is a key trend. Probably oversupplied situation, serious oversupply situation created by pandemic may accelerate the speed of this trend, in my personal views. But day by day, week by week, or month by month, the situation will change very, very dramatically because of the relative difference between the term contract price and spot price and Henry Hub price of LNG from United States. But I think this is a trend. People, the industry, in particular for consumer, is trying to reduce gradually the dependence on the JCC pricing. So I think that JCC pricing is likely to be a kind of the dominant animal in Japanese or Asian market. But I think that the relative importance is going to go down. And I think that the pricing is more diversified to find a way, the best possible optimal solution for both the producer and the consumer. I think that this is a kind of inevitable pathway, long-term pathway, not the short-term, but the mid-term, long-term pathway for the future.
Well, there is a related question saying that maybe Asian market won't be affected too much from this experience because the Asian market is different from the other markets of the world. It won't be affected eventually for the 2020. I wonder also, as a moderator, what would be the case because we have been observing that the LNG demand is not picking up as we all expected in Asian market. Because of this lower price, do you see that it will be picking up very soon?
Yeah, in case of LNG, that I think that the lower price may become a kind of driver, in particular in comparison to the case of oil. When we made an analysis for the city lockdown, I personally noticed that in case of oil, even oil price became very low, it's very difficult to see the bounce back of oil demand. Because, as I mentioned, the demand destruction caused by this pandemic is mainly coming from the city lockdown. So as far as the government said, please stay at home, and people react as government state, I think that the lower price will not have a big impact on the demand side. But in case of gas, if the demand price is much, much lower, and it may work as a kind of a possible driver, in particular for the relatively lower income economies. I think that if the situation happens that the pandemic situation is stabilized, heading for the stabilization, while the price of LNG or gas is much, much reduced, particularly as in comparison to coal, I think that there may be a possible functioning of low price to stimulate demand. But I don't know at the moment.
Nobody knows for sure.
No one.
Thank you very much. Okay, let me go to maybe one of the last questions. The last question about the LNG was actually Mr. Hiroki Sato, and this is going to be Shulika Pradhan-san. He is asking, you mainly mentioned the short-term impact on the oil. What about the medium-term the oil demand prospect? When social restriction has been removed, what would be the case? Will it still be the demand in a reduction in the demand in transport? Will that continue? Social distance, etc. So what would you envision in the midterm after the short-term period is over?
Thank you very much for the question. I think that the midterm and long term, I think that there is a possibility that the oil demand growth trajectory can be revised downward because of the possible substitution of transportation demand by digitalization, which I mentioned in my last slide. And again, we, IEEJ, did not make any quantitative analysis on this. Personally, I think that it's quite interesting topic. This is just my idea or my feeling at this moment. But it's possible that some of the demand for transportation may go on structurally. If everything goes normal in terms of the pandemic, we may start to come back as a really normal economic and social life. We go to our office and we go to the international conference. Everything, it can be normal, but now we understand we can go without big international conference or going to office as normal. The some of the demand may be substituted by digitalization.
This
And
thing.
yeah, this kind of thing. And this will create the loss of the potential demand for oil structurally.
Okay.
The question is, how much is the question? I think that quite likely some of this transportation demand will be replaced forever by the digitalization, but the question is how much? If we assume this volume can be substantial, the possible growth path for global oil demand may be much, much lower than currently or before anticipated. But I don't know. But I
So
think
all
it's
you
possible.
can say, all you can
I
say
think it's
is that
possible.
we
Yes.
have to watch out. The
Yes.
change of the people's behavior
That's
may
right.
influence on the oil demand as well, and will be a smaller oil demand in that direction. So thank you very much, Ken Koyama, and then thank you very
My
much for all
pleasure.
the viewers for excellent questions. I have other questions, but I think we have to close this session. I hope you all enjoyed, and I hope you will come back for the other webinar series of IAEE, and then hope you will also check out what IEEJ will be announcing in the coming few months. Thank you. So over to you, Dave.
Thank you, Yukari. IAEE wishes to thank Ken Koyama and Yukari Yamashita for quite an outstanding webinar. I know I personally learned a lot, so I'm very, very grateful to you all. For everyone, this webinar is going to be archived on IAEE's website for future download. Please don't hesitate to check this out online. And if you're not already a member of IAEE, we encourage you to join by visiting www.iaee.org. Thank you for attending, and I officially close this webinar. Bye now.